A much-awaited budget is behind us. The expectation was that it would give a 2 lakh crore, a 3 lakh crore farm giveaway. It's been a much more modest 75,000 crore giveaway, though there is some benefit to the middle class as well. Okay, maybe a 1 lakh crore giveaway. Now we also have a monetary policy 5 days from now. How should the stock market react? On Friday itself, after a rally, we saw the market give up some of its gains. But what's the road ahead for stock markets in general and particular sectors that were advantaged in particular? We have with us a star panel to tell us that, and our star stocks editor as well, Anuj Singhal. Hi, Anuj.
Hi, Latha. Good morning. You know what? I tell you something. The budget was quite interesting because at one point it looked like the market's taken all the positives and was breaking out. And then when we reached 10,980, the classical resistance for the market, a simple risk reward played out and the market saw that big decline. Of course, there was this realization as well that perhaps everything was not as good as you thought, and the devil is always in the detail. But once again, we are back in the range, and now that we have failed at the higher end, the worry is that do we again go back to the lower end? Let's find out.
Yeah, actually, I take your point that 10,980, but 10,980 also coincided at that moment, at about 1 o'clock, with the market realizing that the borrowing program is much higher than what they were expecting. And so you saw the yields started going above 7.35. And the realization that this 5 lakh, tax giveaway is not for all. It's a rebate. So a couple of realizations on the market, on the budget clarifications were available, and maybe that also was a reason why you saw a reaction.
And just to add to that point, that that the fact that the cost of money is going to be higher is per se equity is negative, especially mid-cap negative.
Exactly.
And that's one reason why the Indian mid-cap market has underperformed over the last 2 weeks.
Okay, but yes, so we have to see how things will pan out from here on. I guess the monetary policy on Feb 7th will be meaningful. But to parse all this for the stock markets, we have with us 3 veterans. Navneet Munot, the Chief Investment Officer, SBI Mutual Fund; Gautam Dugar, Head of Research, Institutional Equities at Motilal Oswal Financial Services; and another Gautam Chowcharia, Managing Director, Head of India Research at UBS Securities. Gentlemen, thank you very much for obliging us over the weekend after a rather hectic Friday. Well, Navneet, let me start with you because I want to raise exactly the point that Anuj is raising. Higher borrowing. And we saw the bond markets react, going from 7.26 on the new 10-year to ending at 7.38. Cost of capital goes up. So how should the stock markets take it?
But as you mentioned earlier, that I think the market's fears about whether a farm loan waiver or any kind of package, I think those fears were much more than what the actual number was. Of course, the market is looking at a higher gross borrowing as well as the extra budgetary borrowings, which is also reflected in the higher corporate spreads, particularly for even the AAA corporate spreads. There are a variety of other factors for the equity market. I don't think it's the borrowing alone which led to. And I don't think market is like so smart that everything has to get discounted in one day. There are so many other events than the budget. You talked about the monetary policy next week. There are so many things happening globally. Of course, you have a political calendar, which is quite important. And on top of that, the earnings trajectory and variety of stock-specific news flow that we have seen in last few weeks.
It looked like at least one sector which was pricing in everything in just one day was autos yesterday, and consumption in general. Do you get a sense that, and this is a reasonable bonanza for consumption, consumption was one pocket which was doing well anyway, except autos. Do you get a sense that perhaps now autos will also join in?
So of course the monthly numbers have been weak for last few months, of course on a higher base. Valuations have become relatively cheaper, but I think people have been saying that this is a big boost for the consumption. Yes, I mean there is more money in the pocket of every segment of the society, whether it's the middle class or the farmers. But extrapolating that, you also have to keep in mind the valuations of relatively of all the sectors. There could be pockets of consumer, I would say, I mean in the discretionary space, not only in the autos but even in, let's say, home improvement, etc., where there could be some value. But just extrapolating that, this is a consumption oriented budget and everything in consumption should go up, and it is negative for industrials, it's negative for investment. I don't agree with that.
Okay. Well, actually, I wanted to scratch that point further. Let me get Gautam Dugad into the discussion. I actually wanted to take the point about what we did not discuss at all, the capital goods. There was in December a time when we thought that, Larsen & Toubro's numbers were very good. They had guided very positively. Now the budget is not talking about capex at all. It quite clearly is the neglected area. Even that 3 lakh crore that they have put in the revised earnings, revised budget is certainly not going to come. Most of that money, even in terms of taxes, is not going to reach the government. Would you worry? Is capital goods and capex and infrastructure an area you would avoid, Gautam? Dugad.
Latha, I concur with that view. We've been having a very positive view on the consumption side of the market for last 3 years. And yesterday's budget reinforces that viewpoint. We've been talking about capital goods, metals, utilities, cement. This has been a neglected area of the market for last couple of years. While valuations have been attractive, but there's been no growth. And I don't see that changing, at least in CY19. What the budget has done is actually given a 1 lakh crore kind of a stimulus to consumption and to an extent real estate. So sectors which again come into favor, specifically if we talk about the budget point of view, is FMCG, low ticket durable items, and real estate along with autos. And as I've been talking about these sectors even during our preview discussion, these are the sectors where we've been very positive. And while valuations are expensive, Navneet did touch on that point. My view is that some of the segments of consumption, specifically staples, discretionaries like Titan, you've seen the results of Titan, you've seen the results of HUL, Pidilite, Asian Paints, Havells. There is a big boom there in terms of volume growth. And after this whole election spending plus government handouts, that will sustain for another couple of quarters. So while one can debate about valuations, I think till the time you see revival in earnings in the non-consumption part of the market, the sectors which are already doing well on earnings front, whether it is consumption, whether it is private corporate banks, to an extent IT, and also some segments of auto now, they will be the one which will be in the focus. And I think that view will continue for us as far as CY19 is concerned. Of course, after election, we will take a fresh card depending on the political outcome.
Okay. Gautam Chhacharia is also with us. Gautam, your thoughts on this, because right now, how I equate the market is, the kind of bipolar market. It's almost like a cricket team where the 1 or 2 batsmen are doing their bit, but others just failing to pick up. In this case, of course, it's just been about consumption, and not that it needed any more boost, but it got that. So, your thoughts? Do you think there's enough for other sectors, or is it going to remain just 1 or 2 sectors really taking the market forward from here?
So a couple of points there. One, what were the analysts or markets building in any way? So as we were seeing for the last few days, markets were expecting some kind of rural boost and consumption boost. And it's debatable whether these numbers are underwhelming or overwhelming versus those expectations. So I was talking to my auto analyst after the budget, and he's been cautious on two-wheelers, for example. And he made a comment that he had built in impact of this in his auto two-wheeler growth numbers for fiscal year 20. In fact, this is at best can support that estimate rather than drive it higher. So consumption boost, the margin, yes. A shift from capex to consumption, yes. But does it really drive earnings upgrades in consumption? No. Does it drive valuation multiples higher? That depends on the overall market outlook. The second point I would make is that does it drive the growth cycle in India? Because we all hoping that post-election, once the political uncertainty is behind us, and now with GST demonetization behind, the banking sector in a better shape, hopefully we'll see the next cycle of growth recovery play out in India, which the markets are pricing in. But when you boost consumption, in our view at least, consumption doesn't drive a growth recovery. You need capital formation or capex-driven growth recovery. So in that sense, this budget is a tad disappointing from that perspective. But yes, near term, it will drive the bipolar market further.
Okay, I wanted to bring, develop the point on the debt market. It's not just that the yields have risen a bit and could rise more because there's an unexpected 36,000 crore borrowing that will happen in the current year itself. But, there are problems coming out of the woodwork. It was not just IL&FS, and it is not just the October problem. A mini October is in the offing, perhaps. Therefore, do you think that we have, mid-caps have a problem, Navneet?
Have we not seen that? I think it's been there for almost a year.
Will they continue?
One after another story. I mean, you mentioned about the IL&FS in September and October. Then over the last few weeks, we have seen
you had SL Group, you had DHFL.
Certain stress in the credit market. So while, I mean, you may look at the government bond market and say, okay, 10 or 20 or 30 basis point movement, but the spreads in the NBFC segment and some of the other corporate segment has moved up substantially higher. And I think that will create a little bit of stress in the near term.
That's an interesting point that, which has been touched upon over the last 2 or 3 days, especially with the mid-caps. Gautam Duggad, I wanted your thoughts on this because yesterday Saurabh Mukherjee was making this point that what you're seeing right now with the DHFL fiasco, Z fiasco, is essentially, a lot of these come out when liquidity dries up. When the liquidity is there, a lot of these things get masked. But right now, what you're seeing clearly is a classical case of liquidity drying up, and so these cases coming out. Do you think this has the potential to derail equity markets further?
Anuj, if you see mid-caps versus large caps, last 12 months have been very harsh for the mid-caps, and rightly so. Because if you go back 12 months, January 18, what we've been writing is that the mid-cap premium to the large cap at that point of time has risen to almost 60%. The underperformance of last 12 or 13 months has obviously brought that down to 10-15% now, but it is still a premium, and so therefore you cannot throw caution to the wind when you look at mid-caps. And couple that with the problem that you just talked about, liquidity, stress in credit market, it does sour the sentiment, especially when valuations are not dirt cheap for mid-caps. Having said that, given the correction that you have seen in mid-caps over the last 12-13 months, there are some interesting bottom-of ideas which are coming up across sectors in the mid-cap space. So situation is not as bad for a stock allocator or a money allocator as it was 12 months back. One just needs to be a little more cognizant of which sector one is putting that money to work and where the valuations stack for those segments of the market. So yes, I do expect large cap to outperform the mid cap, at least till the election related uncertainty is over.
Okay, let me speak about large caps itself. Gautam Chowcharia, Anuj started off with that question. It looks like 10,980 is hitting you every time. But will the bottom give way? Will it go below 750, below 10,600? Are there enough problems and uncertainties, maybe because of polls, that that could happen?
So locally, yes, uncertainties around politics, obviously, because markets are clearly still anchored and pricing in Mr. Modi coming back. So if there's any shock at all, then obviously that's a big catalyst. The other thing worth highlighting is also that post-election, whichever party comes to power, given yesterday's budget, given the promises being made by the opposition parties, the policy space left for any government post-election to drive a growth recovery is very, very constrained. So while we will see boost to rural India, etc., in a narrow sense, but the broader recovery will get delayed in our view.
So you think there is a danger of the index even dipping below 10,600 or wherever the support is now?
Absolutely. So our top-down framework does suggest earnings cuts, and if you look at a fair multiple of 16 times, given the various parameters globally and locally, then we arrive at 10,000 fair value for Nifty by December 19. And if I look at upside downside scenarios also, obviously you could argue that the markets could re-rate further if we have BJP coming back strongly. But the risk reward does suggest that it's an unattractive year. So absolutely it can correct towards 10,000 levels.
That's an important point.
That's an important point. And this is a market which has absolutely rewarded the risk reward over the last 6 months. It mostly does, but the last 6 months has been the prime example. Welcome back. Well, we are having this conversation about the market from here after the union budget. Navneet, so, real estate was one sector which clearly looks like, is going to be beneficial. You spoke about that. But do you think for the allied sector, say, housing finance, which has seen so much decline, or a couple of ceramic companies which have seen a big decline, Could this be a bit of a second coming from here on?
So I mentioned earlier that I think we have seen a significant correction in several of those stocks, several of those segments, and I think there could be a bit of revival there. It seems that government has recognized the stress in that sector. Some measures have been taken. They may or may not be enough to take care of the entire stress which is there in that sector, but I think over a period of time, I'm sure some of those segments can do well.
Okay, and housing finance in particular, with the kind of mess that we're seeing with DHFL, for example, there's a bit of a fear about investing in this sector. Do you think the one or two large caps over there can still outperform from
So
here?
I think there is going to be a market share shift from some of those weaker players to the stronger players and also to the banks. I think over the last few years in the financials, people have focused on the asset side. You rewarded exceptionally well those who were growing faster. You punished them who had the asset quality issues. You never looked at the liability side. Now over the last few months since October, people have started focusing on the liability side as well. And I think banks are in a sweet position where they have a stronger liability franchise. And I think their ability to grow both by buying the portfolio from the HFCs who can originate well and also by doing on their own. I think from both perspectives, the banks can actually regain the market share, and also some of the stronger players within the HFC will be able to regain the market share from the weaker players.
Okay. Gautam Chowcharya, if you fish in troubled waters, where would they be? Would they be the real estate stocks at all?
Property, yes, property absolutely, because a few simple points. One is that in our top-down view, the next big cycle in India's economy will be driven more by property cycle than the private capex cycle. And secondly, if you look at last 3 years, all the property listed stocks, even in the worst property cycle, they have delivered good numbers in terms of balance sheet, cash flows and growth rates. So that risk reward looks attractive to us, but it's a small sector for sure.
Okay, a similar question to you, Gautam Dugad. If you are going to look for bargains over here, other than Realty, you said that some mid-caps have returned to good valuations. Which are they? Would they continue to be the pizza guys, the specialty restaurant guys? Where would you look for value?
This year my approach is going to be a little more defensive, at least in the first half, and that basically means that my positioning will further strengthen into consumer, into IT, into select private corporate banks, where you're seeing very clear earnings visibility now that all the three big corporate banks have delivered the results. And as Navneet was expanding on that point, I agree with him that this is a year where there will be a big market share shift away from NBCs towards liability reached private corporate banks. Aside of that, some segments specifically in NBC, if you look at stocks where there is a valuation room for expansion, some of the even within housing finance where companies like LIC Housing Finance with very strong parentage and very strong credit rating with valuation at 1.2, 1.1 kind of a book, those stocks can continue to outperform given that you do not have very high expectations to begin with. So those are the 3-4 sectors where nothing new in that, which is something which we've been liking for some time. And given our view that one has to be a little more defensive in this year, those are the same sectors and stocks that will continue to have our positive view on, even Titan for that matter.
Okay, actually, thanks for that, mentioning those stocks. But, I wanted more a macro question addressed. Navneet, flows. We spoke to a series of FIIs before the budget, asking them their view on India. And the almost universal view was it's too expensive. Even if it is growing, it is all in the price. And it is expensive now because there is a large amount of domestic money that has flowed. Is that safe, those flows?
So off late it has slowed down, but structurally I think still we have a long way to go in terms of financialization of savings. And if the government is trying to put more money in the pocket of middle class, and I think they understand that they need to save more and invest better, which has been the trend over the last few years. Also think about it that since yesterday a lot of people told me that okay, this is going to be real estate revival because of certain measures that have been taken in the budget. I meet a lot of investors who have a second house which was invested few years back. They're waiting for that opportunity to sell that so that they can put money in an equity mutual fund. So I think we have a long way to go as far as equity flows are concerned, but I agree that given the volatility over the next few months, I think flows may slow down a little bit. Unlikely that we get substantial flows from the foreign investors. This liquidity drought, drought may not be a right word, but a slowdown in the liquidity or a lower liquidity in the market will create or will accentuate the volatility in the near term. And then you have the political calendar, you have the global cues, and all of that news flow as well.
No, my point was, because of the flows, is the bottom protected? I mean, there is a reality.
Of course, no doubt about it. So you have more than $1 billion
10,500 or whatever
SIP.
is a real.
You have a more than $1 billion in SIP. You have few $100 million coming in from pension funds. That continues, and that will ensure that that will ensure that there is a floor in the market, at least from the domestic flows perspective. But are we going to see the flows that we were seeing towards the end of 2017, early 18? May not be in next 2 or 3 months. But I also tell you one thing: there are a lot of investors who have been sitting on the sidelines or who could book profits last year, and I think they have been waiting for a right opportunity to re-enter the market. I think the overall thesis that financial instruments or the equity markets are a better investment than most of the asset classes, that hasn't undergone a change.
Okay, in fact, I wanted to extend that point because we all knew it was going to be 4 years of governance and 1 year of politics, right? Now, when we're seeing that and the market, of course, sulking, for equity investors, do you think it's time to perhaps sit tight and wait for this volatility to be over? Do you expect a very strong second half for this market, which takes the market to new highs?
So first of all, on that, if market is sulking, I think that's not the right way to reacting. For 4 years, you have taken measures which are growth enhancing, which are removing the bottlenecks from the growth. They are the measures to improve the productivity and efficiency of the economy, which has resulted in formalization, digitalization, financialization, and all of that. At some point in time, distributional aspect is equally important. And I keep saying India in some manner has launched the universal basic income. So free toilet, free LED, free, the LPG cylinder, pension, medical insurance, free debit and credit cards, some benefits for girl child, some benefit for senior citizens, pension for informal workers, so on and so forth. So we have launched our universal basic income, which is critical to reap the demographic dividend which people in the equity market bank on. When they're talking about the consumption, they are talking about the demographics, and for that all of these things are important. Can second half be good? I think market will realize that all of those growth enhancing measures, they will have the result in the second half, and then for the years coming, where the growth will go up and corporate profits are at bottom. In the first 6 months, I think the volatility is likely to continue, and we are going to have a roller coaster ride.
Well, I would also give some value to the caution that Gautam Chowcharya put on the table. It's good to hear this optimistic end to this conversation, but I think Gautam's
view. I think brace for a substantially higher volatility.
For all that we have done, girl, child, pension, Atal Bima, whatever, India is a deeply iniquitous country, and therefore I'm not very confident that there is a consumption boom. We are out of time, but we must carry this conversation off air as well. Gautam Chowcharya, Gautam Dugad, Navneet Manoj, it was a pleasure speaking with you. Thank you very much for putting the budget in perspective for a stock market investor.